Hi folks, Duncan here once again from CapitalQ, and today I will be briefly discussing the 20,000 instant asset write-off, otherwise known as the 20,000 small business tax break. So the first thing I must mention is that as at today, being August 2018, the extension of the instant asset write-off for the current tax year is unfortunately still not law. Now, I think it is fair to say everyone expects it will eventually be passed by the government, but given everything going on in Australian politics at present, you should be aware until it is actually passed into law, there is always a chance something could change. Having said that, working on the basis the extension for this year is passed as expected, here are the key things you need to know about it. So why does it exist? In short, the government is looking to achieve three things with this small business incentive. One, they are encouraging Australian small business to spend and therefore help maintain the economic activity of the country. Two, they are attempting to encourage Australian small business to invest in and therefore hopefully expand and grow their own businesses. And three, they are of course attempting to provide some tax relief to small businesses who are owned and operated by people who vote. So what is the benefit to your business? Well, simply put, under the normal tax depreciation rules, equipment you buy that costs more than $1,000 but less than $20,000 would normally have to be claimed for tax purposes over a period of several years. But instead, under this rule, those equipment items can be claimed for tax purposes in full upfront. And we estimate that the short-term cash flow improvement to a small business from this rule can be around as much as $8,000, so that's not too bad at all. How do you qualify? There are three main criteria. Number one, your business must qualify as a small business entity. Now, there are obviously tests that need to be applied to meet this criteria, but in general, if your business turnover is below $10 million, you are most likely in. Number two, you must have incurred expenditure on an eligible depreciable asset during the year that costs less than $20,000. And three, that eligible asset must be used or installed ready for use within your business on or before the 30th of June 2019. So what are the tricks and traps? As with pretty much everything in Australian tax law, things are never as simple as you might hope. Even with just three criteria to pass within each of those categories, there are various things you need to be aware of to avoid getting tripped up. But probably the key things that are the most common traps are as follows. Number one, the turnover test applies to all the businesses you own. So if you do own more than one, you must combine the turnover of all of them when applying the test. Two, incidental costs of acquiring the item are included in its cost for the purposes of the write-off. So this means costs like delivery, installation, duty, they're all included in the cost, and you must ensure they don't tip you over the $20,000 threshold. Three, the cost of an item excludes GST. You can claim back from the ATO. So you can actually buy a piece of equipment costing all the way up to $21,999, and so long as it includes a full 1/11th GST and you are able to claim that all back, then that will get you under the threshold. Having said that, the most common thing small business owners want to claim the write-off for is cars. And most of the time, what you pay for a car doesn't include a full 1/11th. That's because of stamp duty and licensing, including in the cost. Those things don't have GST. So be careful, because you may not be able to get under the $20,000 limit. Now, we do have a detailed blog on the website about this particular topic, so check it out at capitalq.com.au. Of course, there is always even more to know and consider. We can't cover it all, even in a blog post. So if you're hoping to make a purchase and utilise the write-off and its benefits, give us a call and we'll check your eligibility and make sure you get it right. But one last thing before I go. Despite all the apparent benefits of the instant asset write-off, please don't just go and buy things that you don't actually need in order to qualify for it. You will still be out of pocket, and even after the tax savings, and such a strategy, it's a complete false economy. I will confess to being a little bit disappointed with the number of people who ring me in June usually and ask, should I buy a car to save tax? The answer is very clearly, unless you really need a new car, then no. That question does indicate a bit of a lack of understanding of how the tax system affects them and a lack of understanding of good business practices. And maybe it's a poor reflection on the impact of our government initiatives and the advertising that creates this misconception. So always remember, don't just incur an additional cost just to receive a tax deduction, because you rarely come out in front. Anyway, enough of that. We'll see you next time. Bye for now.